Doom evening, everybody, and welcome to DNN, the Doomers News Network, where we give you the doom, the whole doom, and nothing but the doom. So help you God, because somebody has to. Mainstream financial press, all they ever do is put lipstick on that pig and tell you everything is well, and if things aren't going too well, maybe you're the problem, not the financial system, not the state of the economy. So we just tell it how it is, guys, because somebody has to. And with that, I am going to turn it over to my buddy Travis. How are we doing today, Trav?
I'm good, man. I think there was a little problem with the intro, but you saved it. So I'm very impressed. I just wanted to say to everyone that I don't beat up Jack. Jack and I play all the time, and happy Friday. Thank you for joining us. We have a great show. We barely put it together, but we're like, we got to do it. We got to talk to you. Thank you for joining us, guys. We plan on giving you overwhelming value. Starting with this week in Doom, Jack's going to take over that. My story, guys, is going to be on recession, unemployment, and the housing crash, just like the title. The second story is going to be from none other than, it's this way. I'm sorry. Is it this way? None other than Melody Wright, who's here, ready to go. And our last story, we're only doing 3 stories today, is going to be by Jack, and he's going to be talking about open AI, essentially, potentially, possibly going bankrupt, and AI doesn't work. It's just an algorithm, or what? Shocked. It's not a robot. So it's not going to come alive. Is that what this is going to be about, or?
Skynet needs to crack that whole count to 3 barrier before it takes over the world. So I mean, we got a few days.
Okay.
By the way, I did flub the intro a little bit. I'm sorry. It's my 3rd live stream of the day. We're a little banged up here, but
hey, you're a trooper. And I think, Trav, you need to mea culpa here, buddy, because everybody's asking why we're on a Friday night.
Because I messed up, and I'm a bad person, and that's why we're here today instead of tomorrow. And I'm still trying to catch up. I mean, if anyone follows my own channel, Real Estate Mindset, you guys know I haven't even been able to do a video a day. So, it is what it is. But you know what? I'm never going to miss an opportunity to correct Jack. Never, ever. Hold on to that.
How can you possibly improve upon perfection, Travis?
It's not easy, brother. And that's why I go out. But anyways, let me just give a quick shout out to Raymond. Raymond, brother, I love you. A big member of my Discord. Always private chat. We're always private chatting each other, lifting each other up. That's what community is about. Friday night at the Doomers. Have a good weekend, Raymond. You too. This is a great guy. This is a man with American values. Doesn't drink. Sweat equity, is always working. Looking for a good old fashioned woman. Okay, I don't know. He doesn't think they exist. I might hang out. Just keep pushing, man. Keep going. I mean, it is hard out there, is it not? Jack, what do you think of me? How's your dating life, Jack?
I am a married man, brother. My dating life, there ain't one. There's occasionally a date night, but
man, yeah. I mean, it sucks, man.
Been off the market for a while now.
That's my boy right there. Look at him. Thanks again, Raymond. I appreciate you. All right, Jack, you ready to go, brother?
I'm ready to rock. Let's bring it on. Could we share my screen, because it is time for This Week in Doom. And we had a wonderfully doomy week this week, starting off on Sunday night when President Biden surprised absolutely nobody when he dropped out of the presidential race and threw his support behind Kamala Harris. And one by one, the Democratic Party has said, okay, I guess we're doing this. And they're all pretending to be excited about Kamala's candidacy. And we can all look forward to months and months of what can be unburdened by what has been. Also going on this week, on Tuesday, we got the Mt. Gox Bitcoin finally got moving. This has been years and years in the making. Mt. Gox was the largest crypto exchange in the world. That is up until February of 2014 when they got hacked and everything got stolen, which is the origin of the phrase, do not ever leave your Bitcoin on the exchange. And well, the Mt. Gox Bitcoin, some of it has been recovered. And for years, there have been legal battles and fights in court trying to figure out who's going to get what to pick from the bones. And well, this week we had billions of dollars worth of Bitcoin was moving. Bitstamp started by moving about $2.8 billion worth of Bitcoin from their exchange to the creditors, the people who lost their Bitcoin in the hack. We also had Bitcoin exchange Kraken moved about $3 billion worth of Bitcoin onto their exchange and started distributing it to their customers. Overall, there is about $9.4 billion worth of Bitcoin and Bitcoin Cash that is owed to over 120,000 of Mt. Gox's former customers, who have been waiting for more than 10 years to get their money back. And despite all of that Bitcoin that's finally gotten moving, a lot of people were expecting a big sell-off in Bitcoin when this finally happened, and there was some volatility this week. But Bitcoin ended up closing the week at $67,870 after starting the week at just over 68,000. So it was down a little bit, but really, all things considered, Bitcoin held up pretty well. Also going on this week, the Japanese yen surged this week big time, something that our very own Miss Melody has been talking about on this channel, the strengthening of the yen and possibly the unwind of the yen carry trade. The Japanese yen started the week at about 157.4 yen to the dollar, and it strengthened all week, ending at 153.7 to the dollar. It at one point reached as low as 151 to the dollar, and that has people starting to speculate about the unwind of the yen carry trade. Again, something we've talked about on this channel, as people who borrowed yen and then converted to other currencies to buy assets in other countries with that borrowed money now start to cover their yen shorts by selling those assets in order to convert back into yen and to cover their shorts. So that began this week. It carried through all the way pretty much up until the close this week. We'll see if it continues next week. And it may have also contributed to a very strong sell-off on Wednesday in Google and Tesla stock that started when both companies reported their earnings. Both companies were broken down pretty heavily afterwards. Tesla announced some pretty lousy automotive earnings, but Elon Musk assured everybody everything is okay because we're going to have humanoid robots, and that robo-taxi that he's been promising for years is just a few months away again. And of course, Alphabet announced that they were continuing to pour billions of dollars in CapEx into investments in artificial intelligence, over $13 billion this quarter and $12 billion for the next 2 quarters. And when asked if there was a risk, if maybe Google may have been over investing in AI, Google's CEO said that there was more of a risk of underinvesting versus overinvesting, which in my opinion means everybody is jumping off of this bridge. So I guess I better too. And between the yen and the sell-off in Google and Tesla, that has a lot of people talking about the great rotation. And that's me, a little shameless self-promotion, because I was just talking about the great rotation on my live stream on my channel just a few hours ago. Everybody is saying the AI trade, people are going to start rotating out of those high-flying tech stocks and into what exactly, I don't know. As far as the week goes, the NASDAQ ended up closing down 369 points this week, now down 1,300 points from its high on July 10th. Some of the lower valuation and more dividend-paying companies in the Dow Jones may be seeing the benefit of that as the Dow rose 336 points this week, although all of that was today with the Dow rising 623 points just on the day. Then on Thursday, we got some bad news from banks and offices with 2 stories in particular. First one was across the pond in Germany. We had Deutsche Bank setting aside 476 million euros. That's about $517 million in credit loss provisions due to losses that are piling up in commercial real estate, namely offices, and about 60% of their office portfolio is here in the States. That 476 million euros in credit loss provisions is up 19% year over year. So the losses in commercial real estate here in the States reaching all the way as far as Germany. And we also on Thursday got earnings from New York Community Bank, something I believe Melody will be talking about later. New York Community Bank posted $390 million in credit loss provisions. That is a 690% year-over-year increase as losses in commercial real estate, namely office and also rent-controlled multifamily residential, continue to pile up for New York Community Bank. Then on Thursday, GDP, I am a mushmouth today. GDP exceeded expectations. The U.S. economy grew at 2.8% in the second quarter. That is up from 1.4% in the first quarter and well above the 2.0% the market was expecting. Most of that growth was driven by increases in household spendings as Americans continue to go into debt to try to maintain their standard of living, which has gotten much more expensive due to inflation. Also contributing to the rise in GDP was growth in inventories, along with another increase in government spending led by defense spending. Some of the negatives included residential fixed investment was actually the first decline in quite a while. And we saw the trade balance go further into negative territory, which also detracts from GDP as imports grew faster than exports. And last but not least, today we got PCE, or personal consumption expenditures. This is the Federal Reserve's preferred measure of inflation, and it came in roughly in line with expectations, albeit a little bit higher than the market was expecting. Headline PCE came in at 2.5% year over year. That is down ever so slightly from 2.6% in May, but directly in line with the 2.5% the market was expecting. The month-over-month number was a little higher than everyone was expecting. It came in at 0.1% month-over-month. That is up from 0.0% last month and versus 0.0% expected. And then for core inflation, which strips out volatile food inflation, we got 2.6% year over year. That is flat versus what we saw last month, but slightly higher than the 2.5% expected. And month-over-month core inflation was 0.2%. That's up from 0.1% last month and higher than the 0.1% expected. So although this inflation print was ever so slightly higher than the market was expecting, it is still largely seen that the Fed will continue with plans to cut rates in September. The market is pricing in a near certainty of rate cuts by the Federal Reserve at that September meeting, and thus ends This Week in Doom.
Travis. Okay. I see Melody was on mute, but I just got one question. maybe a run-on question. I don't know. Is the run-on question a thing or a run-on sentence? But Jack, I just want to know what's going to happen in the stock market. I mean, and this is why I say. So, the whole week the stock market's down. PCE comes high, and then it rallies 600 points. Can you explain what's going on with the stock market, brother? And then, is next week going to do the same thing? What do you think is going to happen in the stock market?
I'll say PCE was high, but just barely. It was pretty much in line. It came. Yeah. Some of the statistics were a little bit high, but I don't think it was so high that it's going to change any plans for the Fed. That 2.8% GDP print, that might have given the Fed a little bit more hesitation than PCE today. Look, the market was up today, but it was up after pretty much a bloodbath midweek in the NASDAQ, right? The NASDAQ finished higher by 100 points and change today, but it had fallen almost 800 points in 2 days on Wednesday and Thursday. So stocks have reversed. The Dow was just modestly positive for the week, but the S&P was lower 2 weeks in a row. NASDAQ was lower 2 weeks in a row. I don't know if this is the crash or anything. We really won't know until NVIDIA reports earnings. As goes NVIDIA, so goes the entire stock market. And that's still a few weeks away.
So do you think, Jack, that, I think there was some conjecture that perhaps, Powell would cut at this next meeting, but you think this PCE kind of sealed the deal for not happening this month?
Yeah, I don't think Powell will cut in July. The likelihood of a cut in July is still like low single-digit percentages based on interest rate futures. Powell deals in certainty more than anything else. He doesn't want to surprise or spook markets in any way. And I think a July rate cut would come as a very big surprise. And Powell really likes to telegraph his moves ahead of time. So I still think September is when it's likely to happen.
Yeah, that Nick Timmer's article was kind of like a head fake, right? I think when people saw that, they were like, is Powell trying to tell us that he may cut in July? But then I think with PCE coming, did you see that article?
I'm not familiar with the article you were mentioning, but I am familiar with Nick T is pretty much Powell's mouthpiece at the Journal.
Yeah.
And that's the market, guys, right there. So not right there, Melly. That's a 95 point. CME Fed Watch, but they've wrote off a rate cut in July. Looks like
they're always right, though, right?
They're never right, ever, never.
Right.
The first cut was supposed to be in March, wasn't it? How's that going?
The first cut was
people were partying in December. Yeah, people were like having a party. So yeah, but yeah, I think his article was on employment and kind of how that had broken. If I'm remembering it correctly, I'll pull it up while somebody else is talking. But I think that made people think maybe perhaps that message was, Powell was trying to telegraph it. But I think everybody kind of went back to their original assumption today.
I do think employment is probably now more prominent in the Fed's thinking than inflation is. I think they're probably leaning towards, okay, we've seen employment start to rise for about a year now. it's probably time to start easing because unemployment is not going to stop going up after our first rate cut. So I do think that's probably the more important data point right now, but still July still, I don't think we're going to see the cut in July. I could be wrong about that, and everybody else could be wrong about it, but Powell generally doesn't like to surprise people.
Surprise with transitory inflation. But I think we'll save this comment for the end. So you guys throw up some comments. We're gonna towards the end, we're gonna answer some. This is probably one I'll keep from Raymond. Let me hide that. How's you ready for me to go, Jack? I see you're on silent there, buddy. Oh, you want me to go now? Okay. All right. So I'm gonna go. I'm gonna put myself in presentation position. So what do I want to call this story? I'm not 100% sure, guys, but what I'm going to do is basically kind of play off of the title. I really, quickly want to talk about and present you guys some information on recession, unemployment, and the housing market crash. So first thing I want to do is start with one extremely, and I'm only going to talk about one recessionary indicator this week because I'm sure you guys are getting sick of it. And I'm going to black out myself here like this real quick. Can you guys see that okay? Really what I want to do, guys, is all I want to do is look at the 10 and the 2. And the reason I'm bringing only this indicator up is because look at the trajectory over the last few days. We're extremely close to an inversion. Right now, we're only 16 basis points away from an inversion. Now, what I did is I went back 5 recessions. I skipped this recession, guys, because that's the lockdown recession, and I really didn't want it to taint what my presentation today. But what I'm want to explain with showing you guys this data is we're not necessarily going to have reversion prior to recession. And let me show you what I mean. So first of all, here's the GFC. Basically, here's when we uninverted, basically, but from the time of uninversion to recession, guys, during the GFC was 9 months. Okay, so 9 months right there. And then this recession, the dot-com recession right there, uninversion, and then 3 months. So we got 9 months, we got 3 months, and then look at this. This is the 1990s recession, or in other words, the other recession that had nationwide price decline. Don't tell the bulls that. Don't tell Dave Ramsey that, but we actually had nationwide price decline. Some metro areas got ravaged, especially in California, but nevertheless, you guys, 11 months. So, a lot of people are essentially saying when it reinverts, that's kind of when the stuff hits the fan. I personally watch George Gammon a lot. I love George Gammon with Rebel Capitalist, and he's constantly waiting for the reinversion. Now, what I've been trying to point out, you guys, is this may be a little bit of a different, situation going on here because of inflation. And so what I want to say is like, don't wait for the inversion to prepare. Okay, because we may go into recession while we are still inverted. And if we actually go back to the other 2 recessions I have here, which is the 80s recessions, these are inflation recessions. Okay, right now we have an inflation battle. So I wanted to point out that in 1990, we went into recession while we were inverted. You see this? And the only time, guys, that we actually even uninverted, this is crazy, was during recession. It only uninverted during recession. So it's very interesting. It's actually the recession that may cause the yields to uninvert. And then look at when we went out of recession, it went straight inverted again. Is that crazy? So it's like, okay, it's uninverted again. And then again, we went into recession right here when this thing was inverted. All right. Now, a lot of people are like, oh, okay, cool presentation. Why does that matter? Oh yeah, nice, right? Cool, cool drawings. Did you guys think it was cool drawing? Maybe you didn't. Maybe you didn't think it was cool drawing. I'll just shut up. The reason I keep talking about recession, guys, and I'll tell you why I think this recession is going to impact housing prices, but the reason I'm talking about recession is unemployment, right? It's the unemployment that we're missing. And I don't want people to get unemployed, but I'm saying that's what we're missing. And so here's the point I wanted to make. And why is unemployment important? All right. Let me put this on the screen real quick. Okay. Oh, there's Jack. I'm so sorry. I am messing up, you guys. Boom, boom. Add that to the stage. There it is. Okay. This is the reason why I'm always saying, unemployment, watch unemployment, the house market, it wreaks havoc. I mean, look at this chart right here. This chart is insane right here. This is tracking mortgage delinquencies and the unemployment rate. All right. So the unemployment rate is in orange or gold or whatever we want to call that. I don't want to upset anyone, so just make up your own color. And then the bottom one is a type of blue, maybe turquoise, navy blue. They just can't make it straight up yellow, can you just make this a bright blue? Anyways, you guys, the blue line is the delinquency. So again, I wanted to point out, especially, once we pass 1998, I mean, it's crazy. The unemployment rate almost tracks mortgage delinquency exactly. And so if we have recession, we have unemployment, then what follows unemployment? Delinquency. People stop paying their bills. We have a trackable form here. And so you guys, honestly, that's why I'm constantly talking about recession, unemployment, housing market. Now,
Hey, Travis, could I real quick?
Yeah.
I'm sorry to interject. Could you put that chart back up?
The delinquency chart?
The one you were just showing, yeah.
What do you think?
Because I just want to add, this chart ends in 2023, and it's important for people to note that unemployment has continued to rise. We're at 4.1%, I think was the latest unemployment rate, even though this one is showing 3.5 as the current unemployment rate. So, this chart stalls out a little early here. We're actually already on our way up pretty significantly. Sorry.
That's right.
Yeah.
And so maybe that's why we have some. I don't want to ruin your story, Melody, but maybe that's why we have some delinquency companies like, oh my God, delinquency is exploding. But then we have this other one that's not. Something ain't adding up here. But either way, you guys, unemployment tracks delinquency. So I think it's really important to watch those things. All right, let me go back now to here. Now, let's talk about the foundation. So we got the unemployment, we got delinquencies. Obviously, that will lead to forced selling. Forced selling will lead to additional pressure on prices going down. But let's not forget, you guys, the foundation of the housing market. You guys may have seen a couple of videos, but I just wanted to remind everyone as far as the foundation of the housing market. All right, I want to talk about income. I want to talk about income, and I want to talk about house, price growth, because I think it's so important. I think, if anyone wants to debate, anyone that's bullish on the housing market, this is a really good, presentation to make as far as income and home price growth. So I have circled, and this is every 5 years. Okay. So this is half decades. So we got half decade blocks. All right. I circled 3 times. Okay. Right here. Whoops. My pen is not on. Right here, and right here. I circled those because those are periods of time where home price growth exceeded income growth pretty substantially. Okay. So those are the 3 times there. Now I put small right here. It was a little bit, home price growth accelerated past income growth just a little bit. And I put small there because the next year right in here, we actually had price decline on a nationwide level. I just wanted to point that out. Okay. Right there. But what I really, really want you guys to understand is right here. This is the GFC. Look at the income growth and look at the house growth. Okay. People are like, oh, it's not going to crash. It's not going to crash. Well, we don't know that yet because the last 5 years hasn't happened yet, right? And so that's the GFC. This is current. All right. Very, very similar gap of home price growth versus income growth. But when we adjust for inflation, the income growth is actually probably more like down here when we adjust for inflation. So, it is what it is. But what I'm trying to point out is like, everyone calm down. Maybe we need a little bit more time because look at what happens the next 5 years of the decade. Okay.
Hey, Travis, can I point something out again in this chart?
It depends what it is.
Well,
tell me first.
And then you tell me if I can't.
Okay.
This is showing the rate of change, right? A percent growth, which means the strain, the difference here and the stress that it places on people is cumulative. Right. So the fact that the home prices rose so much in the past, more than wages, that pain is still with us. So that big price difference from the GFC versus what wages did, that little bitty correction that we saw in the GFC, that never went away. So the difference between these 2 charts keeps getting bigger and bigger over time. So it's not like I can look and say, oh, well, the difference during the GFC was bigger, so this time isn't so bad. No, this is this difference on top of that problem from the GFC, making it even worse. That's what I want
right. You're damn right, Jack. You guys.
Okay, so having heard that, can I interject then? Okay.
No, you can't. Don't interrupt me.
Okay.
All right. Anyways. And to Jack's point, that's why I circled like right here. We had a little bit of, out of whackness, and then the next 5 years it reset. So the next 5 years is like the reset years if we're looking at and comparing only home price growth compared to income growth. And again, right here is when we had the GFC. Okay. So we still have this whole story to be told over the next 5 years. All right. And that's really is, that's like the most simplest, like, talking to so many bulls and looking at so much data and listening to everyone's opinion, like, oh, Travis, you're wrong. Well, how? When you look at the data, I really think that is one of the biggest holes in the bulls narrative on how the housing market is going to stabilize. I keep trying to explain to people, and so does Melody all the time, how could it's not possible. It's not possible for this to sustain for everyone, right? Obviously, rich people that purchased right, people that purchased prior to quantitative tightening. I mean, unique situations exist, but I mean, my God. And then the other thing I wanted to explain as well, we're talking about the foundation of the housing market. Look at this, guys. Okay. This is my double bubble analysis. Okay. This is my double bubble. So right here we have case grifter. You know what I'm talking about, Melody? Case grifter. You get it? Anyways, that's case Schiller.
I get it. I got it.
Okay. So that's our case Schiller right there. And here, this black line is basically the consumer. All right. This is CPI, consumer purchasing power, consumer health, blah, 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 blah. And what I wanted to point out is right before lockdown. So let's just talk about right here to about right here. All right. Now in 2012, I don't know if you guys realize, but that's when quantitative easing happened in the form of mortgage-backed securities. So I blame this bubble right here that you see on 2012 quantitative easing. People are like, what? I didn't know that. Like, go back and look at the mortgage-backed securities. So what happened around 2017 to 2019, two things happened: quantitative tightening and Fed funds rate. Okay. Now that happened right about here. So this is, at that point when they really started trying to clamp down on the market. But and honestly, guys, and I tell Melody this, I tell you this, Jack, I actually rebudgeted. I was a loan officer in the business. I felt the slowdown in 2019 because the rates were going up, right? I mean, I felt the slowdown. But again, instead of that, slowing down, like maybe it doesn't have to narrow the gap, but at least slow it down, right? And talking about cumulative risk, talking about the cumulative, like Jack was saying, and instead of that, narrowing and slowing down, all that happened is it went even more out of whack. And people like to point out, well, what about other countries? What about other countries? Like, I'm talking about the US. Okay. I'm not talking about other countries. I'm talking about the USA. So here's another thing. All right. That's the foundation. All right. Now I also hear another bullish, here's another bullish thing. Logan, I love him. He's so petty on X. I don't know if he's listening. Hit me back, Logan. All right. Don't be scared. I want to talk to you again. But anyways, these guys, and again, I appreciate him. They make it really, he pulls up this foreclosure chart and he's like, this is why we're not going to have a home price growth. And I respect the data. I researched the data, but I was like, Logan, you can't compare what's going on right now to when we're in recession. Here's why. Look at it. Okay. So before recession, okay. You guys get it? All right. So this is about where we're at before recession. You can't make that argument.
Are you trying? What are you doing?
Okay. This is foreclosure inventory. Okay. This is foreclosure inventory before and after recession. So what I'm trying to point out is really foreclosure spiraled out of control during recession and not prior. So my point is it would make sense how low right now, because they're also manipulating the data. So there's actually two reasons why it's low right now. But that's one of the reasons why the delinquency rate is low right now. But the reality is when we look at HUD, the delinquency rate is actually higher. Delinquency rate is actually 5%. So it's just kind of like, who do you listen to? But my point is, we didn't really have a foreclosure problem until after the recession. I wonder if that's, something that added to the recession. Who knows? But either way, I don't think it's a good argument to use the recession data. Like when we're actively in the recession, like before the recession is important, right? But when you're comparing right now compared to the worst of the GFC, it just doesn't make sense. That's the worst of the recession. You can't compare the worst of the most horrible recession of my life compared to like all of the government deficit spending and everything is rosy and blah, 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 blah. The public, quite frankly, doesn't know what's happening. In my opinion, that's one of the black swans, is the public waking up. Now, all of this brings me to this next thing here. And this is the most amazing, remarkable thing. You guys heard it here first. Let me throw this up on the screen real quick, guys. Boom, boom, boom. Let's do this layout right here. I want you guys, Melody, Jack, the viewers, I want you guys to remember July 14th. Okay? Because July 14th was our first, and Melody and I watch a lot of data. I probably watched 5 or 6 different median sales prices. So I'm always like, okay, I'm trying to get the first, right? Let me see what's going on. Obviously subdivision review, but outside of my market, I need to know what's going on. And so July 14th was the first indication that we broke seasonality for 2024. And what I'm saying right now, and I'm about to show you guys, from here on forward, prices of houses on a national average, some markets may be okay, sorry haters, whatever, right? Most markets, and on average, home prices are going to be going down from now until who knows how long. And I'm going to bring up a chart at the end of this video, and we're going to say, okay, well, when do we need to break seasonality for this to be considered a full-fledged crash? So we'll get there. But the first thing I want to point out is, despite, if you guys, Vital's probably not listening to this. Vital, I love you. Vital Signs on X, you're on everyone's thread. Why aren't you on mine, bro? Vital, home prices aren't going up anymore on a national average. You cannot say it. If you're saying home prices are still going up on a national average, well, that's wrong. According to the leading indicator that I'm watching, the most recent indicator of median is the 4-week rolling average from Redfin. So I'll cite my data. Is that interesting? No one cites your data. So anyways, remember July 14th. Now, here's the most recent update on median sales price ending July 21st. You guys see that right here. This is a 4-week rolling average. Now, here's the crazy thing, guys, and here's why I'm telling you guys, don't trust these people. Don't trust these people. They don't care about you and I. All they care about is like not going bankrupt. You know what I'm talking about, Jack, Melody? I mean, they don't want to go bankrupt. How do they go bankrupt? The stocks, blah, 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 blah. But look at this. This is such BS and reckless optimism. They said in their notes right here that this is $1,000 below the all-time high set July 17th. Jack, Melody, do you agree with it saying that? Is it saying $1,000 below the record high on July 7th? Is that correct?
I don't have the July 7th record high price memorized, so I'm going to have to take your word on it, Travis, because you told me not to trust these guys a second ago.
I see Melody knew it was a rhetorical question and stayed muted, but that's okay, Jack. I'm glad you chimed in, buddy. So anyways, so what I want to point out, though, is week over week. Okay, so this is the most recent Redfin report. Week over week, we're down in 1 week, $879 on median. Okay, and remember, you guys, the higher end of the median, there's been growth. So it's going to be harder to have decline right now since there's growth in the high end. So the fact that we have in 1 week $879 decline, I think it's a little bit of a big deal. But let's go to the last week. And don't forget, we saw that $1,000. We're not July 7th. This is July 14th. So this was last week's. Just to prove to everyone, it's going down. It's just they're not saying anything about it. I mean, one hand, last week they're saying record high, and now median sales price is going down, and they've shut up about it. You can't trust these people. They only want to be optimistic. They are only going to talk if they figure out a way to manipulate you into believing their optimism. And I said it. I meant it. That's how it is. But look at, guys, the week over week decline right here was, let's see, where did I put that? Oh my gosh. Okay. 1,000, it's about $1,100. All right. So there's an $1,100 decline right here. So let's go to July 7th right here. Here's the record high for this year, by the way, until they revise it. So the record high, so everyone remembers this, and don't forget, guys, Redfin always revises this downward, but I did track down the record high. It was July 7th, but I told you guys to remember July 14th because July 7th was the record. July 14th was the first indicator that we have finally broke seasonality for 2024 with median 4-week rolling average for the first time this year. Beautiful thing. Look at, so 397,482. I don't know if anyone's like a math wizard in here, but all we have to do is subtract that from 395,500. Does anyone know? Is that $1,000? So anyways, guys, it's not $1,000. When we subtract, again, the record right here, 397,482 and 395,500. I mean, you can almost do it in your head. It's almost what? It's almost $2,000. It's $1,982. We are down in 2 weeks. All right. And this is counting the higher end of the median, guys. The higher end of the median is still flourishing. Even with that, and that's why it took a little longer. I was hoping it would happen in June, but it didn't. It happened in July. You guys, we're down almost $2,000 in 2 weeks. We're on an average pace of $1,000 per week. That's an annualized rate of $52,000 a year. But the question is this, okay? Is the same thing that happened in 2023 going to happen in 2025? We had massive price decline, as you see here. Okay. This is the black line, you guys, is 2022. We had massive price decline the second half of 2022. You see that in the black. In fact, this was like the fastest price crash in history. It's not talked about because look, we ended the year 2% up. So because we ended the year 2% up, people wrote this off. But I'm like, yo, this is not normal. This is like really bad. But what happened, you guys? Look at in 2023, seasonality took over again. Now, I believe one primary reason that seasonality took over again in 2023 is because of, as crazy as this sounds, I know it sounds crazy, trust and confidence. What do you mean trust and confidence? Bank Term Funding Program, Fed put. Markets were like, the Fed is going to rescue us. Send it. There's no recession. Could be wrong. But the important thing that I want you guys to ask yourselves is, will we break the seasonality in 2025, which starts about right here where my mouse is? So normal seasonality starts about the end of February. So what I'm trying to, let's talk, Melody. Let's talk, Jeff. Okay, you guys want to do some talking? You guys want to talk a little bit?
I'm a little
Melody,
nervous, Trav. What you been drinking over there? There's some debate about it in the chat. Diet Mountain Dew has been suggested, but no, it's a Monster. Okay.
It's not radioactive horse piss.
Pretty much.
Bro,
Pretty much.
Hey man. I barely made it today, bro. It better be radioactive. If it's not working. You know what I mean? I try to come hard to the pain every time, brother, even when I'm tired, because I love you guys and I feel like we're blessed to be in a position to help people. People are listening to what we're saying, and we're not like telling people to waste their money. Like, I know what you guys are saying. Right? The trolls and the haters, like, oh, you're this and that. Like, no one's going to tell me what I'm doing. You know what I'm talking about, Melody? Except Melody's going to tell me. Actually, my wife, and it goes God, my wife, and then right under my wife, like a hair under, is Melody. Those are the only people that can tell me what to do in my life. Jack, you're making progress, but you still can't tell me. My question, though, guys, I mean, Melody, do you think? Here's the question, right? Because
I thought I was going to ask you a question, but go ahead.
Wait,
okay.
I'm not. Because people are going to say, like, oh, it's just seasonality, right? They're going to, I believe what will happen is the bulls are going to say it's just seasonality. Home prices are going to rebound February of 2025, just like they did in 2023. But don't worry, your boy's been watching it this whole time. I got this on the back of my hand. I know exactly what's going on here. But are we going to break seasonality in 2025, Melody?
I think so.
Why?
Well, I think largely because of supply is going to be a big part of it. But then also we are definitely seeing, and we'll talk about this in the next story, that delinquency and job loss. I follow Macro Edge. I think you guys do too, and the layoff tracker. And that thing is just going full steam ahead. And so I believe we've already broke seasonality in the existing home market right now in June. I mean, we broke it. So I think that's going to persist. Is that the answer you were looking for?
I'm going to tell you the answer I was looking for. Okay.
Okay.
Everyone sit down for this. Okay. The answer I was looking for, Melody, was your honesty, straight from your heart and soul.
Okay.
You know what I mean?
Got it.
I need to knock that out.
Thank
So, just to recap on Raymond, what I said is breaking seasonality. I believe a big reason why in 2023, trust and confidence.
By like, the FN put. Yeah. BTFP.
The Fed put yes, BTFP. Jack.
Yeah.
What do you got?
Did you never realize those initials stood for that, Travis?
Only until you reminded me like 10 times, and I'll probably forget it in about 5 minutes.
Sure. All right.
Trav, I would say we're on pace to break seasonality mid to second half of 2025.
Okay.
Historically, after the first cut, several months after is when we get the surge in unemployment, where we go from a slow increase to a dramatic spike that usually follows a few months after the first rate cut. And it also usually follows, as you pointed out earlier, shortly after the yield curve inversion, both of which are happening within a month or so of each other. Now, there's not very much savings left. Most Americans have virtually no savings left and are living check to check because of inflation. So I think the timeline from unemployment to foreclosure is probably going to be a little bit shorter this time around because they're not going to have that cushion. It's gone already from the cost of living. But one big variable, the banks playing pretend. What if the banks just decide we're going to pretend like it's not happening and they don't foreclose, even though people aren't paying their mortgage, right? We're seeing something similar in commercial real estate where they're just pretending it's still worth what it used to be worth. And we're seeing the same thing in private equity, where all the private equity funds are just pretending the companies they own are worth more than they're really still worth. So maybe the banks just play this stupid game of hiding their losses somehow, and they buy for time. So maybe it goes a little bit longer into next year. I don't know.
It's not the banks though. Let's just remember the non-banks do the majority of lending, and most of that is government. And yes, they've already come out with a modification program that has a 20% payment reduction, and they're even going to use principal reduction. So absolutely, this is going to get slowed down. But looking in the mortgage books that I do, this is very sticky. We're going to have and the thing about it is, I think I've been arguing all along that we're not really going to have a foreclosure crisis. And I think Travis has argued quite well. We didn't have one last time either, and that's not what caused the issues. And so, yeah, they're going to foam the runway for these companies through these programs. But the delinquency is building out there. And those are people that cannot get another house. They can't qualify for rent. Because once you get that 30-day hit to your credit, now could they do something next year, 2 years from now, where everybody gets a debt jubilee, clean slate? There's all kinds of things that could happen that we've never seen before. However, due to the vacancy out there, the supply, and the fact that your boomers they cannot afford these homes, and especially in places like Florida, which has massive second home ownership, I think that is why you're gonna looking at these particular factors for this time around, that we will break seasonality unless there is massive fiscal stimulus, not even monetary stimulus in the spring, in my opinion.
Melody, you helped me pass an epiphany. Get it? No?
Was it an existential crisis?
It wasn't existential, but you just oh my God, I just realized something, because there's all these preconceived notions. First of all, during the GFC, we didn't know what I started in loan modification. So I have a little tiny experience with loan modification, but the reality is during the GFC, it's possible that loan modification took longer than right now because the banks have it more perfected. If it wasn't for the moratoriums.
Accurate. You are 100% accurate. It was like trying to get that first HAMP program up. I mean, I remember the CEO threatened the guy over that operation that he was going to drive to Pennsylvania and shoot him with a gun. I mean, that's how stressful it was when we were trying to implement HAMP because we didn't have the systems to do it. And so we are actually in a situation now where they call it the streamline mod. I mean, that's what it is. Yeah. It's streamlined. You don't even have to apply for it. They send it to you in the mail. And so, it's a completely different thing now. But I think we've done, actually, if you look back, we've already done all of that. And we were just confused about the state of our economy. I mean, that was the forbearance. That was the partial claims, the payment deferrals, the 40-year modifications. That's already been done. And that's what I think people can't, because they keep looking at those home equity charts that are not being reported accurately. They're not including those silent seconds that 1.8 million borrowers took. And I mean, just think about it, 2000, it's $50,000. I mean, that's what people were taking out during the GFC. And so you've had the equity withdrawal. They're just not telling you about it. And so I think people, like you say, Travis, they misunderstand what happened, or they don't know enough about what happened. And they don't know enough about,
I went through it, Melody. I went through it, and it still took me, within probably like the last year to finally start figuring out, get away from the headlines, first of all.
Right.
Because those headlines are messing with my head. And okay, let's look at the data and then let's marinate on the data. Let's try to put it together. But I'm going to put you in the driver's seat because you're ready to go, girl. And
I guess I am. I got a little passionate, didn't I?
Yeah, you did.
Okay, I guess I need to maybe present. But before I present, okay, so this story, I'm going to be talking about mortgage delinquency because this is really a story this month. I was actually surprised myself. I've been talking to all of you guys about the hidden delinquency, right? The fact that there's this huge private note space. We saw the Census Pulse survey that said over 5 million people were behind in their mortgage. That can be found nowhere in mainstream media. And that's in that census pulse survey every month, which is just crazy to me that nobody's talking about it. And then, but if you look at Black Knight, you look at other things like Atom, ATTOM, they're all saying historically low delinquency. And then that Fred schedule that you shared, Travis, that 1.7% delinquency, that is the commercial banks. It's not the non-banks. It doesn't include Mr. Cooper. It does not include Rocket. It does not include PennyMac. It does not include the largest lenders in this space. It literally says commercial banks. And everyone is touting that schedule as if that is delinquency, or you can compare this time to then. You cannot. But if you did compare, you would see that we are exactly where we were in Q3 of 2006. I mean, like you showed, Travis. And so anyway, this month, I have access to the back end of the Black Knight database. I pulled the delinquency information when it was available, not when they reported out. And I could not believe my eyes. I really couldn't believe it because it was so high. I cannot. I've been tracking this stuff religiously for a very long time, and I knew that we had never seen. So overall delinquency spiked 13% month over month. 30+ day delinquency spiked 19% month over month. That is absolute.
FHA?
No, that is all loans. And thank you for the plant. Yes. I mean, because everybody has heard me talk about FHA so much. They're like, is that FHA? No, it's all loans. Fannie, Freddie, FHA, VA, all of it. And remember, VA is on a mortgage, a foreclosure moratorium right now that got extended. It's supposedly voluntary, but as a servicer, you don't really get a choice. And so this was very, very shocking information. And I had to think about, okay, what is Black Knight going to say here? And sure, last month ended on a weekend. It was also the July 4th holiday. So I had a feeling they were going to talk about the calendar because, whenever anything goes wrong or people don't understand it, it's always the weather. That's something I learned on Eurodollar University. But in this case, I can't wait to show you guys the headline because it's just so good. It's just so good. But here's the thing, guys. March also ended on a Sunday. It was also Good Friday, that Friday before that weekend holiday, and delinquency went down. It went down.
Mel,
so, yeah.
Do you want to share your screen?
I'm about to. I'm
shut
preaching first. Okay.
Melanie, can I ask you a question real quick?
Sure. Yeah.
I'm sorry because those numbers were
shocking,
pretty profound, right? 19% month over month increase in 30-day delinquency. Is that normal? What's the typical range? Like your typical week plus or minus? I'm just trying to put this in context here because that seems astronomically high to me.
Right. It's the same, Jack. And so I'm working right now on an analysis of what is like in the season and looking at seasonal trends of delinquency. But I can tell you the last time we saw an increase that even touched a double-digit number was in April, May 2020. So it was when those lockdowns, the last time we saw it during the GFC, like the first time you saw that kind of, because I was just thinking, dear God, I don't remember that kind of increase. But I went back to August of 2007. Between August and September of 2007, you saw an increase almost that high for 30+ delinquencies coming through. And guys, August 2007, that's when everything started to go to hell in a handbasket. And so, honestly, Jack, I was so nervous. I sent it to other people. I'm like, please look at this. Like, because I was so shocked. I just could not believe it. And I've got my screen up now. But Jack, to your point, I'm going to be doing a deep dive analysis into, what like, put it this way. It's usually down like, I don't know, 10 basis points, up 10 basis points. I mean, it does not move like 13%. I mean, that just doesn't happen.
0.1%, right? Is like your typical. No. Okay.
Right.
Yeah. So this is way out of the normal range.
That's
right. What we're talking about. Thank you.
So here is the headline, guys. I hope you enjoy it as much as I did. first look at 2020 at June 2024 mortgage data. ICE first look at mortgage performance. June sees calendar-driven spike in delinquencies. Foreclosures remain historically low. So, hey guys, the calendar did it. Okay, the calendar did it, and
Gets you
this
every
is
time.
what they're talking. So here's the thing: we all know in mortgage that people get caught up in the spring because of taxes, bonus season, that kind of thing. So you every year you can see that little catch up. This year it was a lot lower than it was last year. And so for them to say this, they just kind of say, Sunday month ends often lead to sharp but typically temporary spikes in delinquent. And so that's why I went back to March and said, no, that's not. I mean, I work in mortgage. Here's what happens. Okay. You send your check in on and it gets there on a Sunday. They effective date it. They don't, they are not in the business of wanting this delinquency, because you know what just started at all of these servicers across the country, massive call center activity. And so they are not staffed for this, because when you hit 36 days of delinquency, that's when all of the timelines start for the CFPB, for Fannie Mae, Freddie Mac. You have to do all these calls. You have to send out notices. This is a massive expense to people like Mr. Cooper, which I'll talk about them at the end of this story a little bit. But this is going to be a huge hit to the industry. Just as they kind of saw a little bit seasonal pop in origination for them. But just know that you get that check in and it's going to get effective dated if it's not being done by ACH. Now, here's the other thing, that if you're in mortgage, you know this, and this is what makes me super angry about this story, is either we're at a point, everyone, Jack and Travis, where there are no professionals left and they're just completely inept and they're not talking to the people that know about this, or there's more a nefarious intent here. But in mortgage, you always have habitual late payers. They know they can pay on that 27th day, that 25th day, that 28th day, and it won't ding their credit. But if anybody was a habitual late payer, believe me, with a holiday coming up, they would have figured it out, because they're trying to save their credit. That's what they're trying to do. They don't want, you guys both know what happens when you get that 30 plus day delinquency on your credit. Credit's going to become a whole lot more expensive. So they don't want to do that. So this is why this story is just so upsetting and concerning to me. Because they are also the people who are supposed to be leading the industry. That's who the industry turns to. But something that I've realized by having access to that back end information, they have like 34 million mortgage loans they track. Different sources say different things, but most of them are in the 85 million mortgage range, meaning that Black Knight is about a third of the actual mortgages out there, which is something I did that segment here talking about. So this is just, this to me was very, very galling. I have to say, I was very upset about it, but just taking a look at what it's going to mean. And you can take a look at this chart, Jack. This shows you, it's hard to see because it got caught off. It goes all the way to June, but you see that little tick right in June. I mean, it's just a straight up line. And the last time you see it, sorry, I'll do a little right there, that little head right there. That is just significant for what it's looking like. And the last time we have anything like that, really, because this was more gradual right here, right? But that's when the last time we had anything that resembled going, kind of straight up. And so it's small. We're still at lower delinquency, guys, but it's sticky. And this is, of course, they're going to get captured by these new modification programs. And that's going to delay things. And it absolutely, Jack, your point is still very valid, which is why I don't think we'll see material foreclosure until June of next year. But the state AGs, your attorney generals, or even federal will get involved and do a moratorium. I mean, that's absolutely what will happen. And I think you've heard me argue that we talked about it on one of your shows once. I think in some ways, these data breaches, things like that, are set up as a way to come into the servicers when that delinquency happens, and again blame the servicers. That is very much what the 2011 playbook was like. So the other thing about this delinquency that's super important, that the people who called the crash last time didn't even realize. One of them, I had shared this chart on X Twitter, and they put it in their Substack. They're one of the people that, actually was looking for these early payment defaults before. That information used to be more available. And so you can see here the later vintages of origination, like 2021, 2022. These are the most delinquent, and that is the most concerning. And Travis, I know you've shared this on your channel as well, but essentially, and guys, the rate of change here, and I haven't had enough time with this data, but I will be doing a rate of change because in April, there were 3,000 2024 delinquencies. Guys, these are loans originated in 2024. There were 3,030. By June, there's 9,600. That is, again, those are low numbers, but that rate of change is really important. And I think we're going to just continue to see 23, 24 increase as well. I mean, 21 and 22. Every time I do delinquency reviews of my clients' books, those vintages are absolutely the worst, and they are just. I mean, they're
Melody?
Yeah, go ahead.
I just wanted to clarify. I'm looking here. So it is crazy. Is this? Am I looking at this right? So delinquency went down during the GFC. Because right, is that what I'm saying? So 2006, it spiked over 6, and then it actually delinquency was actually going down into the recession. Can you explain that to me? Is that what I'm looking at? How's that?
Well, it's certain types of delinquency, right? Like the 120 plus, but you're just talking about generally from 2008 that it went. This is according to Black Knight's data, right? If you look at the Fred data, it actually peaks out, I believe, in like the end of 2010.
Right.
But yes, in this data. And so, I was in the thick of things. We didn't see really delinquency going down. So you're correct. And I think this is why they never show the back. Do you know in their reports, they always show the 2005 or the 2003 to 2005 average. They don't actually show. Yeah.
Melody, oh my God. This is the first time me looking at this. Is 2000 and am I looking at this? So 2019,
you're looking at this. You're looking at this 2008 right here, right?
I'm looking at the right graph, the right side graph.
Oh, the right. Oh, I'm sorry. Okay,
that's the year of the loan origination, Travis.
Yeah,
not the year the delinquency happens.
Yeah.
What does it mean by total percentage of delinquency then?
No, that's percentage of total delinquency. So this is as a whole, there's according to Black Knight about 1.7, 1.8 million borrowers. As a percentage of that total is this.
That's all the people who are currently delinquent, what year their loan was originated.
Okay, so that's just a year of origination then.
Oh, I thought you were talking about over here, which I was like, yeah, there is some down movement in some of these that I had.
No, I was like, why is that showing down on the right side? Because you see what I'm saying? If it's a total percentage delinquency.
No. Yeah.
Okay.
There's just a lot fewer of those loans. A typical mortgage pays off in 7 years. That's the average life of a mortgage, and a lot less when you're in a refi boom. So I was like, I don't know why delinquency.
Like it's going up. I have no idea. It's showing up here.
You just mentioned refi boom. Does that chart on the right, delinquency by vintage year, does that distinguish between a refi or when the house was bought, or just any mortgage when the loan was originated?
You mean on the right chart?
Yeah, the right hand chart.
It's any year. It does it. It's so it could have been a refinance. Correct.
So I'm not surprised then we see a lot of delinquencies for 2021 and 22, right? Because everybody refied during those astronomically low rates. But what I am very surprised is that those golden handcuffs aren't working. people are delinquent on their loans even after refining to nothing of an interest rate. A lot of those people are still going into delinquency. That just goes to show you how bad the inflation problem is, because most of these people are still working. Unemployment's rising, but really slow. So most of these people are still working. Their payment was probably cut, what, on average, $400-$500 when they refied from, say, a 2015 mortgage down to a 2021 mortgage. And now here they are going delinquent because the cost of everything else went up so much. Imagine if we didn't have that boom in refis when interest rates.
I'll do that analysis for you, Jack, because I can look at the cash out refis and I'll pull those out of and do that because I think that would be a really good. But a lot of what these borrowers are is they bought in 21 and 22 and they just cannot, and they got those tax notices and the escrow notices went out, doubling payments. I've seen tripling. I mean, and so it's a lot of these borrowers that bought then, but I'll do a good analysis where we can look at exactly how many cash outs are delinquent versus, because I do have that data, and that'd be a really good analysis. Trav?
30-minute warning.
Yeah. So I can be done. Two things I quickly want to talk about is, so as you and I, this week was a big week for you and me because I think history was made, right? In terms of just the fact that if you look at the little black line here is 2024, all these, so I have the 25-year average here. I have the bubble years, 2005, 2021. But I have 2007, which is that teal line, or as you say, I don't want to offend anyone. You can call it whatever color you want.
Vanilla.
But yeah, vanilla. And then we've got 2008 in that kind of purpley. But here we are. And so you can look at 2023, man, to your point, Travis. I mean, we were in bad shape. I mean, we really were. For perspective, we were tracking right along 2008, went under it, over it several times through the year. Now
and
this year
is higher.
And is now say I at 100%. And this is absolute numbers, guys. Absolute numbers, meaning that it's much worse. Or the alternative, because I don't want to be disingenuous or a hypocrite, the alternative is there's a lot more transactions happening outside of the MLS that we don't know anything about, right? So that could be part of it. But if you look at our little we're taking a little detour down. We broke seasonality. In the 25-year data series, there was no lower June. And the next lowest June was June of 2008. So huge. But of course, all anybody cares about is the all-time high in the price. But again, this is why math matters. I'll say it now and I'll say it at the end of the show. When you're looking in that median, and let's say you sell one for $1 million and you sell one for $575, one for $395, one for $350, your median price is $475. Like that's, this is about the fact, and you look at that schedule from the National Association of Realtors that I probably have somewhere, but the only increase, year-over-year increase in sales were the 1 million plus category. That was the only increase. The lowest decrease was in the 750,000 to 1 million category. So when all that's being transacted out there are these higher price homes, you're going to have a higher price. And I think this is when median gives off a very false signal. But I think what we also saw, Travis, is the fact that we flipped, used prices got flipped to being essentially higher than new prices. And so that had happened last month. We got data revisions that kind of reestablished the order, but then this month it happened again. And so, typically just seasonality, prices have now peaked, and we will not be, I think, piercing that unless sales really just dry up to only, it's possible, right? It could be that if next month it's the same deal and people are but I think that what happened with the assassination attempt, I think what's happening in the stock market, I think Jack's next story, actually, I think people, and then also with Biden stepping down, they're becoming mistrustful about the data, the information they're hearing. And Powell even mentioning that he thought something was wrong with the employment data. And I think that Main Street is getting a little nervous. And so I do believe we will probably start to see prices come down from here. And like you say, Travis, I think we will break seasonality next spring as well.
You're talking about, I mean, we talked about trust and confidence being a primary reason in 2023. Well, we just had assassination. Is Biden alive? I just want to make two comments real quick. And I know we're short on time, but you brought up a really good point. And I want to ask you, going back to Black Knight, which to the viewers, Black Knight is, like Melody was saying, is very well known and actually very well respected for some reason, data provider of delinquency. So a lot of professionals in real estate are leaning on Black Knight to educate their consumers, right? And my question to you, Melody, is being that, and this is a roundabout, so this is not exact numbers, but being that Black Knight only has 35% of the pie, and they're only taking the best servicers, wouldn't it be impossible for them to see the incoming turmoil if they're not tracking it, Melody?
It could be if they're not reading Inside Mortgage Finance, for instance, because they do their own delinquency tracking, and they do it by servicers. But I think we shared here in that segment that they don't include all the servicers, because if you don't want your bad numbers to be shown, they don't have to be. But if you look at Inside Mortgage Finance, you can see servicers like Specialized Loan Servicing, which was just sold to New Res, part of that's a big deal. They were all in like a 7% delinquency already. So I think what it is they don't have these smaller specialty servicers on their platform. And so they don't see it coming. I cannot wait to see that Fred schedule update, to be honest, because it should show up at the banks as well.
And last thing, in other words, we can't, they can't accurately project turmoil coming. If everything is rosy, then it's just even more rosy. But Melody, you just said
calendar driven.
You just said that the transactions essentially roughly about a 25-year low. So it's a 25-year low, at least a 25-year low. Population is way bigger right now. Is it even possible to have a, let's just call it, price discovery with such probably when we adjust for population, not inflation, when we adjust for population, this may be one of the lowest volume, a couple years in history. Is it even possible to have price discovery with such a low transaction volume?
Well, I think our friends, the builders, will have something to say about that. And I think that they have to move their product. And I think they got a little cute last month and thought they didn't have to cut prices as much. I think they looked at the stock market too, got a little happy about this rate cut that's coming in September, theoretically. And I think they didn't cut prices. I think they still did incentives. But, if you read Zelman, which I do, her survey, they said they didn't really cut prices that much. I can guarantee you with 9 months of supply, and this is the highest unsold number that I've ever seen of completed unsold new homes, that they will be cutting prices from here on out. And
That's
Trav, now that people have seen your appraisal review, I think that, people will start to get a little nervous.
I mean, what review? You mean this one right here on the screen? You mean that one right there? You want me to show you some appraisal fraud? I got it.
You gave me the time to, yeah. Quickly, I just wanted to mention too, at the end of this story, and Jack, I'll give you I'll let you ask your question if you have another one, but I wanted to talk about Mr. Cooper just a little bit in this NYCB. I think we all need to be paying attention to this transaction. Guys, being on the back end of this stuff, being I was going to say a bad word, but when you are at the mercy, I know, of the GSEs, of the agencies, when you are at the mercy, they can tell you to do anything, and you are their B word. You will, if they tell you to go to the end of the earth, you're going to go to the end of the earth. because that is your juice. That's how you're making it. I mean, if you're not doing government loans, you're not making it, and they're non-banks and they don't have deposits. So this NYCB deal, just have in your mind that this might not even be something Cooper wants. This could be a forced marriage by vested interest. And let's also pay close attention to what the deal ends up finally being, because I guarantee you that they just got this information as well. I mean, Cooper is the largest servicer of in a certain category. There's a ton of categories, but I can guarantee you they're all freaking out right now. I'm sure Black Knight called them and said, I mean, these people are all connected and, go to the strip club together and the golf course. But I'm sure this calendar driven excuse was given, but anybody in this industry should know better. And any servicer across this country is freaking out right now because they've got volumes they have not seen. And most of these non-banks have not been through this crisis.
I am wearing, that was for Nikki. I'll shut up. Oh my God.
It got weird, Trev.
Yeah,
Jack,
it really did. All right, Jack, did you have another question?
Well, first of all, imagine being at Mr. Cooper and you get a phone call in the middle of the night. You're the CEO and it's the FDIC and they're saying, congratulations, you've been chosen to bail out a failing bank today, because that's what Mr. Cooper did when they bought that servicing business from NYCB for $1.4 billion
right.
this week.
That's
Because
right.
New York Community Bank has burned through Steve Mnuchin's money and they're almost out of it. They needed another cash infusion and Mr. Cooper got it. They got the call. So I wonder what promises were made to Mr. Cooper in exchange for taking over this business and giving that $1 billion.
It might not have been a promise. It might have been, we're not going to take you to task for that data breach. I mean, because that data breach, the agencies could pull servicing. There's so many things that they could do. And that's what I mean. It might, of course, I'm sure they put a sweetener in it, but I guarantee you there was also a little bit of, you really messed up with that data breach, guys. So you need to help us out here.
Yeah.
Yep.
All right. Now we got to talk about AI, about my boy Sam there. Guys, if any of you follow my channel, I don't mince words when it comes to the AI mania and the artificial intelligence bubble that has been created. We're looking at there, that's Sam Altman. That is the godfather of the AI mania. When this thing pops and we're all looking for somebody to blame, start there with this guy. He is the ChatGPT OpenAI founder, along with a couple of other guys. There is more than ample information about him that the public at large should be terrified of him. First of all, he's a big proponent of the Malthusian cult known as effective altruism. That's where Sam Bankman-Fried made his mark. He rules his company with an iron fist. He's got a lot of very dark triad personality traits. And he is solely responsible because the AI mania started on November 30th of 2022 when he released ChatGPT to the public. Something, by the way, that his board of directors didn't even know he was going to do. He released this product to the public on November 30th of 2022 without even informing his board of directors. They found out from Twitter. And since that happened, let's just take a look at this chart real quick. This chart is showing the market cap of the S&P 500 combined, the total value of all the stocks in the S&P 500. And this is bi-monthly data, so we don't have a perfect data set here. But in September of 22, when the market was crashing, because remember, big tech was selling off like crazy. Tech needed something to rekindle interest in tech stocks because people were selling it like the blazes. The combined S&P 500 was worth $30 trillion, $30.1 trillion. Since ChatGPT has been released, we are now worth $45.8 trillion. So guys, this is a $15 trillion stock bubble has been created by artificial intelligence. I just want to put this bubble in context for you to understand how big it is. Twice as much value as all of the combined quantitative easing by the Federal Reserve during the vid. All right. I mean, this is the biggest stock bubble in history. Nothing comes close.
Wow.
All right. $15 trillion of value that has just magically materialized since OpenAI first hit the scene, and then NVIDIA's earnings started running like crazy, and Microsoft and Apple and Google and Meta, everybody got in on the AI train. All right. But it all goes back to November 30th of 2022 when OpenAI released ChatGPT. And that's important because we had this story. Now, this is in windowscentral.com, but this is based on reporting that was done from a website called The Information, which has been fantastic over the last year or so. The Information has done really well. It's paywalled, so I can't bring you the information post right now. But OpenAI could be on the brink of bankruptcy in under 12 months with projections of a $5 billion loss. All right. This company that has created a $15 trillion stock bubble may not be here in a year. Now, this is the headline's a little hyperbolic here. First of all, I'm going to say on the brink of bankruptcy, it means they're going to run out of money within a year. They're probably going to get more from big tech. But the point I want to make here is look at the way these people just light money on fire. They don't make money. A lot of these AI companies don't even have products, let alone income. And OpenAI, which is the leader, the first mover, has all the advantages, has the backing of Microsoft. They don't make money, and they're not even close. Let's look at just how bad it is. The booming AI business strategy is placing major tech corporations invested in the landscape on a profitable path. In the past few months, we've watched Microsoft, Apple, and NVIDIA battle for the world's most valuable company crown. Market analysts attribute their growth in revenue and profits to their early investments in and adoption of the technology across their products and services. But ironically, OpenAI, a key player in the AI landscape, could make losses amounting to $5 billion in 2024. According to a report by The Information, the ChatGPT maker might be on the brink of bankruptcy, with projections indicating it could run out of cash in the next 12 months. For context, OpenAI spends up to $700,000 daily to keep ChatGPT running. The amount is likely to fluctuate as the model becomes more sophisticated and advanced. The report sheds more light on OpenAI's financial status, citing that the firm is well on its way to spending a whopping $7 billion on training its AI models and an additional $1.5 billion on staffing. Those expenses alone stack miles ahead of its rivals' expenditure predictions for 2024. Guys, this company is going to spend $8.5 billion this year. But look at this right here. The ChatGPT makers' operation costs aren't satisfied by the approximately $3.5 billion generated in revenue. They make $3.5 billion this year. They're going to spend $8.5. These guys are burning through cash like you wouldn't believe. Now, let's also keep in mind that they just got a big cash infusion from Microsoft, right? Remember, the big announcement was OpenAI got a $10 billion investment from Microsoft. They were given this astronomically high valuation. But you know, the funny thing, they only actually got $1 billion from Microsoft. They don't advertise this very much. Microsoft only gave them $1 billion in cash. You know what the other $9 billion was? They call them data center credits. And what data center credits are is basically a coupon for a free GPU rental. That's a data center credit. $9 billion of Microsoft's stake in OpenAI was discounts on renting Microsoft's data centers so OpenAI could train their large language model. And the fun fact, when OpenAI redeems one of those coupons for free data center, when they give it back to Microsoft, Microsoft reports it as revenue. And so they're not even round tripping their own money. Microsoft is just passing coupons back and forth between this company that they bought and booking it as revenue when it happens. And the company that they're doing it with is going to run out of money in the next 12 months. And then they're going to have to carve off another piece of themselves and try to raise more capital, even though they are nowhere near making any money. All right. So that's the first thing. The godfather of this, again, the scope of this thing, $15 trillion stock bubble. They've got a year to live without more cash. All right. And by the way, when they raise more cash, are they going to get a higher valuation, even though they're burning money 3 times as fast as they're taking it in? They're nowhere near profitable. Now let's talk about their product, because I hear the product is so amazing, right? It's going to change the world. Google's CEO, what's his name? is it Sundar Pichai, I think is his name, or that might be the Microsoft CEO. Regardless, he said it's the new fire. It's the biggest thing since fire and electricity. Well, let's hear from the people who actually use it. This is in PC Magazine. AI creates more work for humans and contributes to burnout, survey finds. Though 96% of executives expect AI to boost worker productivity, Upwork finds that 77% of employees say AI increased their workload. It made things worse. Now look at the deviation between the executives expect the boost. 96% of them, almost every executive says we're going to get this big boost in productivity. And we're already hearing about layoffs all over the market. People saying we're going to lay off our call center staff because the chatbots are going to do it. We're going to lay off our auditing team. The chatbots are going to do it, right? They're already cutting jobs. And yet the few people that are actually using AI in their day-to-day jobs, 77% of them say it makes things worse. Look at the disconnect between the promises and the reality of artificial intelligence. And remember, it's a $15 trillion stock bubble. The rise of AI is supposed to help companies streamline their operations and will potentially even take jobs away from humans. But a recent survey finds that generative AI tools burden employees with more work, not less. Online freelancing platform Upwork commissioned a survey in the US, UK, Australia, and Canada to examine how AI has impacted the workplace. The study polled 2,500 workers, half of whom are company executives. The other half are full-time employees or freelancers. The survey found 96% of executives expect AI to boost worker productivity. Emphasis on expect. However, the same poll indicates workers are struggling to improve their efficiency with today's AI tools. Nearly half, 47% of employees using AI say they have no idea how to achieve the productivity gains their employers expect. And 77% say these tools have actually decreased their productivity and added to their workload. Gotta say that again, guys. I gotta read it again. $15 trillion stock bubble. 77% of people who use AI tools say it decreases their productivity and adds to their workload. It makes things worse. As for why, the survey found that 39% of employees often have to spend extra time checking the AI's work, since some chatbots are notorious for making things up or hallucinating. See also glue your pizzas together, eat rocks, all these marvelous things AI has come up with in the headlines recently. Meanwhile, 21% of respondents said they have had to spend extra time learning how to use the same tools. In addition, 40% of employees feel their company is asking too much of them when it comes to AI. Consequently, 71% of full-time employees are burned out, and 65% report struggling with their employer's demands on their productivity. And even more alarmingly, 1 in 3 employees say they will likely quit their job in the next 6 months due to burnout over being overworked. The results suggest generative AI may be a double-edged sword like other office technologies, such as email, and that's mildly put. So let's look at these two things holistically. And Travis, I'm done with my screen, brother. We're talking about a $15 trillion stock bubble that was created by this one company that initiated it. That company may be bankrupt in a year because they're burning $8.5 billion when they're only taking in $3.5 billion. And the people who use their product say it makes things worse. It slows them down. It burns them out, even though 96% of their bosses think it's the greatest thing since fire and electricity.
And they never coded. Yeah.
Oh my, this bubble is so monumentally stupid, guys. And we saw the beginnings of this bubble, just a little bitty sneak peek this week or in the last 2 weeks with this 1,300 point drop in the NASDAQ. Guys, we're just scratching the surface. And I think when the smoke clears from this thing, everybody's going to be saying, how could we let this happen? How could we let this happen? And I just want to mention, nobody saw this coming.
And nobody special saw this. Nobody is special saw it coming. Yeah. Well, Trav, should we do questions now from the audience?
Yeah. Okay. All right, let me pull up some questions. I was going to say, I mean, technology and systems are only as good as the people that use them. Anyways, so hey, I got one for you guys right here. You guys
can tell, right?
Here's a comment from John Wilson. I'm just throwing comments up. I can't remember 100%. GDP went from negative 2.4 to 2.5. Economy is strong. We hear headlines like that all the time. I mean, have you not heard headlines when GDP came out, how strong the economy is, right? Do you want to respond to that, Jack? Is the economy strong?
Well, there was another study recently that found 3 out of 5 people say they have been living in a recession since the beginning of 2023 and are worried about paying their bills. So, yeah, it's the best economy ever as long as you talk to the 2 out of 5 people who don't say
Well,
that.
it's 6 out of 6 people in my household feel it. Melody, here's a good one for you. No crashes until the election. They'll make sure of that. Of the 4 housing market crashes, 3 of them were 1 year after election. 1 was during election in 2008. Do you agree with Raymond on this, Melody?
I think so. And I think, we were talking about the stock market when he put this up. But I think that there is going to be a lot of effort put out there by members of our government to ensure that this doesn't happen. But these things tend to just get out of control. And when the horse leaves the barn, right? They're fine in the barn, but when the horse gets out of the barn, that's when havoc can be wreaked. And I think they're going to do everything in their power to make sure that crash doesn't happen. They're going to do everything in their power to make sure this housing narrative doesn't get exposed. But there is potential that the stock market could crash before the election. I don't want to say it won't, but I would say that there's going to be a lot of effort to keep that from happening.
All right, I got one thank you, Melody, of course. People are like, oh, you're gushing over Melody. Like, what the hell, man? Like, why are people saying that,
Stop
Melody?
being creepy.
Melody is quite gush-worthy. What's wrong with gushing over Melody?
Well, I want to know about it.
Gush.
If I'm gushing over someone, I need to know about it. Anyways, okay. So this one's to you, Jack. He's talking about price to earning ratio, like income during the 1980s, and I love how people make this argument because you can slash them, right? You cut their feet out from underneath them. I believe the average home price to salary ratio, PE ratio, was 2.4. I think it was a tad higher. In 2024, it's almost 8.1. Basically 8 years of salary to pay a house off. Back in the 1980s, they're saying 2 years of salary to pay a house off. So it made sense that equity growth sustained in the 80s because the consumers could afford it and sustain it, unlike now. That's why I'm always beating it. Sorry, Jack. How much higher can a housing market go? I'm like, is this my question? How much higher can the housing market go before it erupts into other markets? Or has it already, Jack? Has it already? And by how much?
Well, there's a quote at the beginning of The Big Short that I like from Michael Burry's, played by Christian Bale. He says, average take-home pay is flat, yet home prices are soaring. That means homes are debts, not assets. All right. And that's accurate here, right? The homes have not gotten any more valuable to us. They're places to live. They've gotten a little bit bigger and a little bit nicer, but it's a necessity shelter for most people, right? It's not, for most cases, it's not luxury or anything like that. So really what you're looking at there with that big jump from 2 to 1 and 8 to 1 is just an increase in the availability and affordability of debt. That's what has allowed that. So don't focus so much on the home price, focus on the availability of debt and the affordability of debt, because I believe we are at the very beginning of a whole new 40-year cycle of significantly higher interest rates. If you go back and look at interest rates, like say, take the 10-year Treasury, for example, go all the way back to the end of World War II, we had about 40 years of consistently higher interest rates. And then starting in the 1980s, just after the inflation of the 1970s was defeated, we had about 40 years of consistently lower interest rates. And if you look, we broke that trend in 2022 when interest rates on the 10-year Treasury surpassed about 2.2%. We broke out of that 40-year downtrend in interest rates. Now we're heading higher. There's going to be cutting and easing cycles along the way, but I believe we're headed for a 40-year cycle of consistently higher interest rates and debts, which means this downturn in home prices and asset prices, it may not be something that just is quick over when they turn on the money printers, because they've got that inflation boogeyman lurking behind the corner now. They can't just spin up the money printers again.
Melody, if this is just the last one for you, and if you have to go. We got like 3 more. Jack and I can, because I don't want her to be mad at me, because you made me promise, like, hey, you know what I mean? I'm
comfortable with you being mad at Travis, Melody. So do whatever.
No, I'm comfortable. I'm comfortable with Melody being mad at me as well.
Serves him right
I'm not
for
talking
gushing.
about. Never mind. All right, so I just wanted to bring this one up here. This is one thing I really am I going to gush? My God, I'm just going to say it that I really respect about you, Melly, and something that like during my journey of being an influencer and calling data and trying to advise people, this is something that caught me a little bit underprepared, a little bit. My guard was down. Like, dang, I can't believe they did the bank term funding program. Like, so there's a lot of policies that I had to understand. To further my comprehension. So Melody, can you go into how important, and let me read the comment. Melody never underestimates some kick the can down the road policy. It's not the bank this time. Can you tell the viewers why it's so important to pay attention to policy, Chevron, Dr. N, things like that?
Yeah, so we did that story, right? The administrative state kind of got its teeth pulled. And so I think that things are, politics are changing right in front of us. And, I don't know who's going to be in the office, but I will say that there is this overturning of the Chevron deference means that the administrative state is going to have to do more to prove its case for some of these secret programs and things like that. So I absolutely, guys, the government's going to do everything they possibly can, but it's not going to stop the train. It's not. I read these hardship letters, I see this delinquency, I see how consumers are struggling. And so unless there's a debt jubilee, or they just say, hey, you can have your house for free, it's not going to stop what's going to happen in the housing market. And, there's a potential some of those things could happen. Crazy stuff happens in times of great stress. But then we're all going to be worried about other things than our estimate at that point.
Great answer.
Yeah, the whole concept, if I could, the whole concept of a debt jubilee, guys, keep in mind every debt, one man's debt is another man's assets. So you might be like, oh, a debt jubilee, my mortgage goes away, my car loan goes away. Yep. And so does your bank account, and so does your 401k, and so does your pension, everything. Like, trust me, that there are winners and losers in that scenario. But most people who are like, yeah, debt jubilee, I'm not sure you've quite thought that one out.
Absolutely. And then, those that honestly, who gets to decide who gets to live in the McMansion versus the studio apartment? I mean, there's all kinds of societal questions that will have to be answered.
We got 3 more questions. So you got time, or you got to get out of here?
Yeah, I'll do it.
This is a good one. This is from Crash Pro. I love your name, bro. If we are in the equivalent of the third quarter 2006 delinquency wise, that lines up perfectly with the Harvard 18-year real estate cycle. I just wanted to add to this. If any of the viewers are wondering what the 18-year delinquency cycle is, I believe that Graham Stephan just made a video on this. So Graham Stephan just made a housing market video on the 18-year cycle, and then Clear Value Tax roasted him on the video. And then I made a video on Clear Value. So in person, I've looked at this. What do you think of this, Jack? What do you think of this?
I'll be honest with you. I am not at all familiar with the Harvard 18-year real estate cycle. So I'm going to defer to you guys on this one.
Melody?
I think you have some passion here, Trav. Why don't you take it?
I mean, it's hard for me. I went back and like, it works a little like, so, okay. 1990, national price, price decline on a national level for houses. 1990, we had a nationwide price decline. So what's 1990 plus 18? 2008. Okay, you got me, but like prior to that, it doesn't work. So I think that what's happening right now is there's just, from all of the money printing and the lockdowns and like how fast everything happened, there's just so much crazy looking data that people are just kind of just throwing things against the wall a little bit. Like I got an email last night from a guy that was like so passionate in my comment section. He's like talking about M2, and I'm like, what's this guy smoking? Like, what is it? So I get his email, and I'm looking at this data. I'm like,
Monster drinks.
I'm like, thank you for sending it, brother. I appreciated it, but like, I don't know what you're talking about, and it doesn't add up. I think it's interesting. I think the 18-year cycle is interesting, but it doesn't really, from a real estate decline standpoint, doesn't really work past 1990. I think that there's more indicators than just every 18 years we're going to have a crash, but it is very interesting. And if we have it, so 8 plus 18 is 2026. I think we're going to have a price decline prior to 2026. I don't think the 18-year cycle works here. I think it's going to be before the 18 years in this case. Myself. Okay, I'm gonna just move on here. This one is for Jack. I think you passed. So how many bailouts happen with this is perfect, Jack, for NYCB before it hits a dead end? This is good, Jack. Question.
We've already had the one when Steve Mnuchin came in and bought the bank out, right? Very curious that a bunch of Republicans would come into New York City and rescue a bank that does rent-controlled apartments in New York City. Not exactly the Republican base. That never quite sat well with me, why they would do that. I suspect that might involve the Kushners, but I can't prove it. Now, also going on, let's see, we had the Mr. Cooper deal just now. That's not quite a bailout. They're buying a business, but it's coming along at just the right time. At the rate New York Community Bank is losing money, they will burn through that $1.4 trillion that they just got in a year. So New York Community Bank, as of right now, has a year to live. And they don't necessarily have an out because New York's rent control board just approved a maximum, I believe it was 2.5% or 5% for 2 years.
It might have been, I thought it was 5, but maybe it's 2.5.
I think it was a 2.5%, or it was like 2.8% for 1 year, but for 2-year leases, they can raise the rent 5%.
Yep, I think you're right.
My numbers are off, but it was a paltry raise. And even that was it was just an absolute clown show in New York because all the tenants' rights advocates showed up and said, no rental increases. The rent is too damn high, all that stuff, which is true. But when your landlord is already bankrupt, well, not letting him raise the rent makes him bankrupter. And so, that doesn't help New York Community Bank because more landlords are going to be driven into insolvency. And New York Community Bank holds a ton of loans against those buildings. So maybe they try for another bailout. My guess, though, is probably before middle of next year, somebody steps in and just buys up the bank with the FDIC brokering the deal. Maybe announced on like a Friday afternoon where it's not quite a bank failure, but the deal happens so the bank doesn't fail. Probably within a year, we see that.
Yeah. I just had a thought too, Jack, about it's the GMAC playbook. We weren't a bank. We had this tiny little bank in Utah, and we became a bank holding company so we could get, TARP money. And that was all. I mean, that wasn't our idea, put it that way. So, I mean, very interesting the marrying of Mr. Cooper here. This could, again, this is a transaction to watch. I just had some additional thoughts.
Melody's got to get out of here. I got one more. But before I do, let me just throw this comment up. Okay, bro. I saw you brought up my comment, but you never addressed it. I wanted to. Travis, bring on heresy. For the longest time, I thought I said Hershey, like a chocolate. Financial, going to debate him because I really want to see you give him the smoke. Bro, what? By the way, Jack introduced, this is Jack's boy. And personally, I love Joe. I think he did a great job. I brought him on not to debate. People are like, oh, he bodied you and smoked you. So I was like, we said at the beginning, this isn't a debate. I was interested to hear his perspective. I think it's great. But if, I would love to kind of challenge, I'll reach out to him. He's a great guy. He helped me. That was Jack's buddy.
I actually just had Joe Brown on my channel yesterday.
Yes, you did.
Joe is incredibly sharp. I think he's one of the best minds in financial YouTube. And in his defense on the real estate thing, for the last 2 years, I've been crash bro, right? Saying houses are overpriced. And I'm not saying houses aren't overpriced, but they've kept going up. Joe has been right about real estate this whole time. So as much as I still disagree with him about where house prices are going, I got to acknowledge Joe's been right so far. So
I mean, you got a good point, except for new homes, Austin, San Antonio, New Orleans, certain places in Jackson, Mississippi, Birmingham, Alabama, and certain places in California as well. So I mean, Austin's year over year decline. So I mean, it's it's kind of a split type thing. You're right and you're wrong. Overall, right. All right, I'll shut up. This is it. Last question. Thank you, Melody. I needed that.
You're welcome.
I love these guys. I'm tired. Can you see my eyes? Does question, does the NASDAQ, thank you, you're supposed to say, does the NASDAQ crash have anything in correlation with the massive AI NVIDIA, Jack? Can you?
100%. I mean, AI is the market at this point. NVIDIA will dictate the direction of the market. One day, NVIDIA is going to report earnings and they're going to forecast growth that doesn't impress market participants. And when that happens, it's going to be a bloodbath. I don't know if it's going to be this time around, maybe next quarter, the quarter after that. But sooner or later, the numbers are just too big. They get too big. You cannot sustain growth like this forever. And they're already using every trick in the playbook, like I told you guys, with the coupons for the free GPU rental, Microsoft giving them the free coupons. Well, that is how they're able to afford to keep buying these NVIDIA chips, is all the investment capital that's flooding into all these startups that we just got done looking at, how the biggest among them is about to go belly up. So, yeah, absolutely. Absolutely. NVIDIA will take down the NASDAQ, and that will take down the S&P 500. And the size of that bubble, $15 trillion, you better believe there's going to be hedge funds that blow up. Volatility is going to spike. So all the people who are picking up pennies in front of a steamroller, short in volatility in the stock market, they're going to get wiped out. You're probably going to see banks go down when that happens, because these banks are all owed money by these firms that are going to blow up because they went out on leverage. You got leveraged single stock ETFs right now. What the heck is this garbage that people are investing in? You better believe it can take down the NASDAQ. It's going to take down a lot more than that. Abso-freaking-lutely.
All right, Melody, do you
Well,
want
that's some proper doom right there? Like, that's there we go. We delivered.
you know, if you guys are okay, let's get out of here. Take us out of here when you're ready, Melody.
Sure. Yeah. So thanks everyone for joining us on a Friday night. We appreciate it. We really appreciate the support. And just always remember, guys, it really, really is important. Math matters.
See you guys next week.